chapter 13, we're going to talk about accounting for partnerships. So partnerships are basically where individuals are going to come together, especially like accounting firms, law firms. We'll set up this way, sometimes construction companies, but it allows multiple people to come together and work and share costs, share office environments, share office staff. The partnership itself will file its own tax return, but it'll prepare a K-1 for each one of the partners, and then those K-1s will go on to their individual tax returns. So there's tax advantages to setting up as a partnership. However, those liabilities that the partnership assumes, those also will pass through right to the partner's personal liability standpoints. So a lot of times private partnerships that are not very big are going to use cash basis or a modified cash basis. But what we want to focus on is the partnership agreement. So that is very important, especially when we get into our accounting, because it is going to tell us how the profit and loss gets split, how income is allocated. Do we pay interest? Do we pay salaries? When are they able to take withdrawals? All those things will be spelled out in the partnership agreement. So we want to understand that the partnership is a separate legal entity. So it has its own tax ID number. It can buy assets. It can enter into loans and liabilities and rental agreements. The partners, both or however many there are, they would all act as agents of that partnership. So again, they could go out and transact business, enter loans, enter lease agreements, and then the entire partnership would be liable for those actions. So unless it's a limited liability partnership, if an LLP, a lot of times doctors will form that way, so then they're not going to be liable for the malpractice of any of their other partners if they set up as a limited liability partnership. If they don't, though, if they're just a regular partner, then they are joint and several liable for the partner's actions. So again, they could be held accountable for anything that any of their partners do. The partner capital accounts is where the partners will invest money back into the business, or they will leave money in the business so that it can operate. And then they will maintain their own separate capital account, and they may get interest on that account if they leave that money in there. Now, they can transfer their partnership interest or sell their partnership interest to somebody else. However, they would need the consent of the other partners to do so. So initially, we're going to set up the partnership, at their fair values. So whatever is being contributed, we'll see that sometimes one of the partners will contribute like the assets of their business. Sometimes they'll contribute cash, but we're going to value all of those assets and those assumed liabilities at their fair value, and then we're going to credit the capital accounts for each individual partner. And we're going to see that it doesn't have to equal the assets that they contribute. There's going to be different ways that we account for those. So here we have Jack, who has his business, and that's what he's contributing. So the net assets of his business are $60,000. Jill is contributing $40,000 in cash, but Jack is willing to let her in as a 50-50 partner. Eventually, we're going to see that, because of her marketing expertise. So if there wasn't the 50-50 partnership, we would just initially set it up as is. So Jack's got $60,000 of capital, Jill has $40,000. The cash comes in, Jill's plus what's in Jack's business. All of the business assets and the liabilities are assumed. Now, if we say, okay, they are going to be equal, but the values are not equal. So again, going back to Jack and Jill, we want them to be equal, but what they contributed was not equal. If there's that disproportionate amount, we say, do we want to recognize an intangible asset, or do we realize that there is some sort of an intangible asset? If we say, yes, we do realize that, but we do not want to record it, we're going to use the bonus method. If we say, yes, we do realize there's some sort of an intangible, unrecognized asset, and we do want to record it, then we're going to use the goodwill method, and you want to be able to use both of those. So again, going back to Jack and Jill, the Jack's business was 50,000, or no, sorry, was 60,000, and Jill contributed the 40. But we say, okay, we know that they're equal, and we want them to be equal. So we have $100,000 of partnership assets. They each should get 50. So if you're thinking about that, in a sense, Jack is giving Jill a $10,000 bonus because of her marketing expertise. And then now they are both equal. Okay, if it's goodwill, we say, okay, we recognize that Jill's marketing expertise is some sort of an intangible asset. She only has to contribute 40,000, Jack's given up 60, so it must be worth 20,000. So then we set that intangible up as goodwill, and then we set them both equal to capital of 60,000. So we're bringing Jill up to Jack, but we're doing that by recording that goodwill. Okay, then when we reconcile it, so sometimes it'll ask to prepare the capital account. So it's always our beginning balance plus any capital contributions during the year, less any withdrawals. And then the income of the partnership is going to be split. It could be to a salary to one of the partners, could be interest on the capital account, and then finally it'll be an allocation of whatever profit is left, and that will provide our ending balance in our capital account. So then how the profit gets allocated is, again, going to be based on the partnership agreement. But like in this example, we have $150,000 of profit. Our partnership agreement says June gets a $30,000 salary. So that's our first allocation, and it all goes to June. And then that leaves $120,000 to allocate. Then it says everybody gets a 5% interest on their capital balance. So we don't see the capital balances on there right now, but $22,500, if I divide that by 5%, Jack and Jill both have $450,000 in their capital accounts, and they're getting interest. June, I believe, is added into this at some point in time during the year, so that is the amount of interest she earns during the time that she's there. And then that we're going to subtract out of the $120,000. That leaves $67,000 to split, and then we go to their profit sharing split, which is 40% to Jack, 40% to Jill, and 20% to June. So the $67,500 times 40% gives us $27,000 to both Jack and Jill, 20% to June, which is $13,500, and then we totally have allocated out that $150,000. So then we'll go ahead and slide those into their balances. So here we can see Jack and Jill have the $450,000 that I kind of backed into. June again came in during the year, so she has $225,000. They each made withdrawals, and then this is the income that we just calculated over on the prior slide. That just slides right in to their partnership accounts, and then they each have a total that makes up the total partnership. And the drawings come out as a debit, as the drawing from each one of them, because again, we got to take it out of their specific capital account, and it's being paid to them in cash. So that is our partnership accounting.